Welcome to The Explainer. Today, we are dissecting a fascinating market-moving surge from industrial materials giant Kennametal. If you've been wanting to understand exactly how a legacy company can take absolute global supply chain chaos and turn it into massive profits, well, you are in exactly the right place. Okay, let's kick things off with this explosive number, 11.1%. That represents exactly how much Kennametal stock jumped immediately following their Q1 earnings report. In the usually steady, kind of predictable world of industrial manufacturing, a double-digit daily pop like that, that's a massive flashing neon sign that something structural has fundamentally shifted into business. Section 1. The 11% surge. Analyst versus actual. So, to figure out why the market went so wild, we have to look at expectations versus reality. Wall Street analysts had estimated $565.4 million in revenue, but Kennametal actually delivered $592.6 million. Clearing estimates by nearly $30 million signals a rapid, unexpected acceleration in their demand curve that the financial model simply hadn't accounted for. And it gets better. That top-line figure didn't just beat estimates, it represented a massive 21.8% year-over-year revenue growth. This is an absolutely crucial metric to internalize. Historically, Kennametal's sales have grown at a rather tepid 4.6% compounded annual growth rate over the last 5 years. So breaking out with a near 22% growth rate completely shatters their historical averages and proves this quarter is a major outlier. Moving right along to Section 2, Forged in History, a Century of Expertise. You see, to really understand why they are winning right now, we have to look backward. The roots of this advantage stretch all the way back to 1910 with Vasco, leading up to Philip McKenna officially founding Kennametal in 1938. His invention of a tungsten titanium carbide alloy was literally a game changer. It was so pivotal that it allowed them to machine over 50% of all U.S. artillery shells during World War II. They established a legacy of hard metal dominance decades ago, and that deep foundational metallurgical expertise is exactly what's powering their advantage today. Section 3. The Tungsten Advantage, the Supply Chain Edge. So here is the exact sequence of events, kind of like a domino effect in the market. As global tungsten costs suddenly surged, Kennametal's competitors started facing severe sourcing issues and lead time nightmares. They simply couldn't get their hands on the materials. But Kennametal? They leveraged their own structural advantages, stepping right into the void and capturing massive market share while everyone else was left scrambling. And it all boils down to vertical integration. That's the strategy where a company controls its own supply chain, in this case acting as its own primary tungsten supplier. CEO Sanjay Choubey specifically called this out, noting that their status as a vertically integrated supplier is exactly what enabled them to secure materials and meet volume demands when others just couldn't. It is essentially the ultimate defense mechanism in a supply-constrained market. Section 4. By the numbers, the financial impact. Let's really put this into perspective, because the contrast here is just striking. Like we mentioned earlier, Kennametal usually saw a modest 4.6% 5-year annualized growth. This quarter, they hit a massive 19% in pure organic revenue growth. That means this isn't some illusion from acquisitions or currency fluctuations. This is core fundamental business growth, driven specifically by huge volume gains in the infrastructure and aerospace sectors. And beyond that top-line growth, their operating margin expanded from 9.1% last year to 13.4% this quarter. This is huge because it proves they aren't just selling more volume. They are driving serious efficiency in their R&D, marketing, and administrative overhead at the same time. When you scale revenue and expand your margins simultaneously, well, that's exactly when you see these explosive earnings beats. Naturally, the bottom line followed suit. Adjusted earnings per share of 77 cents easily cleared the 67-cent estimate, and adjusted EBITDA hit $121.8 million. Plus, here's a really key driver for the investors out there. Their ongoing stock buybacks have actually shrunk the share count by over 8% in the last 5 years, actively concentrating that per-share value. Section 5. Raising the bar. Full-year guidance. Management definitely didn't shy away from this momentum either. They confidently raised their full-year guidance across the board. They pushed the expected revenue midpoint up to $2.34 billion. Even more impressively, they increased their adjusted EPS guidance by over 70% to a midpoint of $3.88. I mean, a 72.2% EPS guidance jump for a legacy industrial company. That is a massive signal of confidence in their near-term pipeline. During the earnings call, analysts naturally wanted to dig right into the mechanics of this pricing power. CFO Patrick Watson and CEO Sanjay Chowbey clarified a few really interesting takeaways for us. First, incremental volume margins are remaining normal. Second, infrastructure pricing adjusts to raw costs very quickly. However, metal cutting does have a 3 to 6 month lag in pricing. But overall, the volume leverage remains solidly in line with their historical norms. Now, addressing the elephant in the room. What happens when competitors finally resolve their supply chain issues? CEO Sanjay Chowbey made this powerful statement. He said, "Share gains are a mix of structural wins and temporary supply-driven opportunities. We aim to turn these opportunistic wins into lasting relationships." So they know some of this is opportunistic, right? But they're actively deploying targeted campaigns as we speak to ensure these new clients stick around well after the supply chain normalizes. Which leaves us with the ultimate long-term investment thesis to ponder as we wrap up this explainer. Can Kennametal turn these temporary share gains into permanent structural wins? Will this historic tooling giant successfully convert today's supply-driven windfall into a permanent market advantage? It really is the multi-million-dollar question, and it's certainly one we'll be watching very, very closely. Thanks for learning with me today, and keep asking the right questions.